This morning, what we're going to be doing is two things. Going to be talking about two very important things in the domain of international tax planning and international tax considerations. The first is we're going to be talking about double tax treaties. Can you raise your hand, please, if you have ever read a double tax treaty? Lots of people. Excellent. That's what I want to see. I've done this course before when I got two hands in the air, and that was slightly worrying. Double tax treaties aren't that hard to read, and they're not that hard to understand. What I'll be talking about in this session is what double tax treaties are all about, what they do, and what the benefits of them are, and why we need to understand them. So I just want to contextualise what double tax treaties are all about and make sure that we're comfortable with them. The exercise we're going to be doing this afternoon, it follows on from the exercise that you did yesterday, and it's going to be a similar format, but I'm going to give you a slightly more specific scenario, and you will have double tax treaties on your table that you can refer to. So if you haven't had much experience on reading double tax treaties, now will be your opportunity. So in this session, what I want to do is go through what double tax treaties are all about. After that, after the break, we'll be doing a session on substance, which is an important concept now in any kind of planning that we're looking at undertaking. And what that's really about is if you set up a company in Luxembourg and then you have a company in Luxembourg, everyone knows that, and you just have to have the legal form of that company in that country to make sure that exists, right? And kind of, except some of the BEPS measures have insisted that double tax treaties and the model double tax treaty and domestic law normally includes some provisions to mean that you've got to have gone further than that. You can't just have something that's a legal form there in name alone. You've got to have something that has some reality, some real substance. And how do we ensure something has substance? What does that mean? How far do you have to go? Is this a carte blanche to mean that any tax jurisdiction can just say, well, we don't really like what you've done with getting a tax advantage by the existence of that entity in that country? No, it isn't. So there are things that we can respond to on that quite positively. So that'll be the session after the break, and then, like I say, what I'll then do is I'll brief you on what the exercise is for this afternoon, and then we'll be following a similar format to yesterday. Is everybody happy with that as an agenda for today? Yeah? Everyone nodding? That's very good, because that is the only agenda that I have, and I'm certainly not going to change it at this point. So first of all, let's get on to talking about double tax treaties. And in this session, what I'm going to do is talk about what the purpose, why do you have double tax treaties, and what the benefits of those are, and who do they benefit, for whose benefit are they put in place. What I'll then do is talk about some of the model treaties that exist, and there are basically three. Anyone that's read double tax treaties, the first time you read a double tax treaty, you think, wow, this is complicated. How will I ever get my head around this? Then you pick up another double tax treaty and you think, actually, that looks rather familiar. And when you're on to the 10th one, you just think, hang on, these are just a big cut and paste job, which is basically what they are. Because pretty much all double tax treaties follow one of three models. The OECD one is the one that most of us in this room will be most familiar with. The UN model, which is only a slight variation on the OECD model, and the US model treaty, which, guess what, every time the US negotiates a treaty, guess what they drop on the table as the model that they want to be their treaty. They use the US one, but they're all pretty similar anyway. The US one is, you'll probably see least frequently, and that's, like I said, is only a variation on the OECD and UN models anyway. I want to talk about how we interpret treaties, because pretty much everyone in this room, I hope, will have familiarity with interpreting tax law, and you'll have had to sit down and work out what different tax provisions mean and understand how you get to the bottom of what they actually do. When you're looking at double tax treaties, the process is similar, but there are special challenges that double tax treaties present, not least because you're dealing with two countries' legal systems, you're dealing with two countries' languages, and you're dealing with two countries' cultures. And these make interpretation not nearly as easy as you might otherwise imagine. And how do you resolve some of the obvious clashes that produces? I'll talk about the key elements in tax treaties from a tax structuring perspective, and I'll talk about, I mentioned this yesterday, the multilateral instrument, which is sort of a blanket addition to pretty much any tax treaty that exists. So in addition to the provisions of any particular tax treaty, you've got to consider things that may be taken to be added in to those tax treaties by virtue of the multilateral instrument. So we'll talk about all of that as we go through. A big point that I want to make is this. Tax, and I'll be saying this over and over again as we go through this session, tax treaties are only one bit of the jigsaw. They're only one element of what you are considering when you're looking at any cross-border planning. And sometimes irritates me slightly that people talk about the use of the phrase treaty shopping, and they talk about looking for the most favourable treaties and going with jurisdictions that have lots of treaties. That is a factor, but it's only one factor. The process you're going through when you're looking at any cross-border arrangement does come onto the tax treaty, but the tax treaty only ever helps. What does a tax treaty not do, by the way? Anybody? What's the one thing a tax treaty doesn't do? I can think of one exception to this, actually, with French law, oddly enough. What does it not do? Well, it doesn't raise tax. A tax treaty doesn't tax anybody. It relieves. That's all it does. There's actually a French provision which operates by reference to the fact that if it is relieved under the tax treaty, then you get a tax charge. So that effectively creates a tax charge, but it's not the tax treaty's fault, it's your fault. It's the French government's fault. So tax treaties are relieving provisions. They put limitations on the amount that countries can take as withholding taxes on certain payments. That's broadly how they work. And that's all they are. Just bear that in mind. So the point is, if they're only relieving provisions and only things that can ever help, what's way more important than that, than what the provisions of the tax treaty are? What's the starting point? If you're looking at any cross-border transaction, if I'm setting up a company in the Netherlands that's owned by a UK company, what am I looking at first? Is it the double tax treaty? Come on, guys, I know it's early. What are you looking at first? What law are you looking at first? A little louder, everybody. Sorry?
First, the local law.
Local law, yeah, domestic tax law. Yeah. What's going to tax you is the UK tax laws or the Dutch tax laws. These won't. These might help you, but there's no point even thinking about these. They might help you. You've got to start off with what the local law is. So the first thing you're looking at is local law. Then you're looking at special anti-avoidance provisions. Then you're looking at myriad other factors before you're getting onto the tax treaty. So the tax treaty, when you're looking at any cross-border event, is a factor in it, but that's all it is. Everyone happy with that, yeah? I just don't want to exaggerate the importance of them. And tax treaties really are there to stop. Well, they're there to help encourage international trade because they're trying to take away things that would be real problems in international trade or international movement of capital or international movement of people. And really, it's double taxation. You're very unlikely to trade with a country if instead of suffering 40% tax on the total income from your trading venture, you're going to suffer 80% tax because one country takes 40 and the other takes 40, are you? So where you get double taxation on the same income, you've got to have a pretty amazing business plan for that still to stack up. So tax could completely scupper a commercial venture if you end up with double taxation. And so two ways in which you can get double taxation. It doesn't really matter whether you remember this or not, but what's called juridical double taxation, which is basically two countries trying to tax the same thing. So, for example, you may have a payment coming from the UK, going to Spain. Under Spanish law, that's taxable on the recipient in Spain. Under UK law, it's taxable on the payer because of a withholding tax. That's what you call juridical double taxation. Or the other one is where the laws identify two different persons who are both taxed on the same amount. And that might be because you have a transparent entity under one country's law. So you might have a holding company in one country, a subsidiary in another country. The subsidiary country tax it. The top company, the holding company's jurisdiction, also tax the income on the assumption that the subsidiary wasn't taxed because under their law it wouldn't have been taxed. So you get that kind of thing happening as well, where two different persons maybe in the same group, maybe related, are taxed on the same income. They both come down to the same thing. That we refer to as economic double taxation. It's effective double taxation. The same income hasn't effectively, no one's tried, no one's fought over it. It's just how it actually ends up. It comes back to the same effect. All of that would scupper lots of international transactions. And this is in the UN Model Tax Convention, Model Tax Treaty. By the way, convention and treaty in this context, the words convention and treaty are interchanged. So if you hear me saying Model Tax Treaty or Model Tax Convention, I mean the same thing. They're not two different documents. And basically this is recognised, this problem with double taxation is recognised in the preamble to that particular model convention. And the point is that you need to find a way to eliminate that, and you need to make sure that double tax treaties are effective in eliminating that if you want to have proper international trade operating in the way that everyone wants. And so, guess what? Lots of countries have signed up to lots of double tax agreements. And we normally talk about pretty much all tax agreements are bilateral. They're between two parties, two countries. You can have a tripartite tax agreement. You can have multilateral tax agreements, but I can't think of many. Can anyone think of an example, actually? Yes?
Nordic countries.
Oh, really? Okay, fantastic, yeah. So is that tripartite, then, or is it multilateral?
4 or 5. Looking at Sweden, 4, I think. Yeah.
4, okay.
Norway, Sweden, Denmark,
Okay, 4, yeah. So, and, it's the same. I mean, I'm guessing the point is that because you've got a lot of commonality between fiscal systems and between judicial systems, that makes sense, yeah? With most countries, it's a big enough job getting a bilateral agreement done. So well done on getting 4 countries to agree to the same things. That's obviously a harder task. And there are over 3,000 of them at the moment. The vast majority are based on the models that I talked about. The EU hasn't specifically, there isn't an EU model treaty per se, and the EU hasn't really responded to this by saying, right, we want to do our own thing in pushing forward bilateral agreements. There's no directive from the EU telling people that they have to have double tax treaties. It's left down to member states. But I think that's really, it's really that, I guess there's no need to respond to that because pretty much all EU member states have, they're all pretty well networked with tax treaties. So you don't need a directive telling people to sign up to a whole load of tax treaties with different jurisdictions. If that changes, if people join the EU, to replace people who are leaving, then, who maybe aren't very well treaty networked, maybe they will issue a directive on that, telling people that there's got to be, you've got to have treaties with certain jurisdictions, but at the moment that doesn't exist. And here's a little diagram sort of telling you what really is happening under a bilateral treaty. You could express this in lots of ways. Obviously, by implication, a bilateral treaty means that there are 2 states who are parties to it, and the treaty they enter into gives certain rights to both states. They can both do certain things under the treaty. They can both get certain amounts of information. They can both have certain taxing rights in respect of certain events and certain things that are going on. And it also places obligations on both those states. Well, obvious, isn't it? Ultimately, it's the domestic law that taxes. There's your taxpayer. It's the domestic law of both countries that ultimately taxes the taxpayer. The treaty provides certain benefits to mean that the level of taxation isn't uneconomic and doesn't end up in double taxation or something that operates unfairly when the 2 jurisdictions interact. That's all it's about. And ultimately, what they're about is to remove double taxation, because it's been recognised that if you have double taxation, you will simply destroy lots of otherwise good business ventures that would be beneficial to everybody in those respective states, and frees up the possibilities for international trade. That's the big picture, and that's the big aim of double tax treaties. Everyone happy with that, yeah? Basic, simple stuff. Apparently some of the earliest double tax treaties came in to help diplomatic movement, so it's diplomats who were moving around and they found themselves in a particular jurisdiction and having suffering special levies or whatever just because opportunistic governments saw a chance to get some extra revenue from these poor souls in days before internet or even telephones, and that was what actually produced the original need for the first double tax treaties. More recently, a cross-border investment and movement of people between different jurisdictions has been the big driver. Countries wanting to encourage investment, as every country does, but countries wanting to encourage foreign investment will be very keen on making sure that potential overseas investors don't view that their view of the possibility of investing in a particular jurisdiction isn't tarnished, isn't affected by the fear of some imposition of tax at a rate that's unacceptable. A little more recently, the large volume movement of people between jobs, people on secondment, people working for multinational enterprises, all of that is facilitated and only really made possible by the existence of decent treaty provisions. Otherwise, you'd find that workers for some multinationals would be taxed twice, and it would be completely uneconomic to operate a multinational company with lots of workers. Treaties also provide a degree of real certainty for businesses when they're doing business cross-border. The average tax treaty lasts about 15 years. The average tax provision in domestic law will last a little less than that, won't it? You've only got to get a change of government, which happens quite frequently in some jurisdictions, and domestic rules can change. Every year, pretty much every country, their chancellor will stand up, or the person in charge of their exchequer or their treasury will stand up and announce changes to the domestic tax code. That's what happens all the time. And these can happen, in fact, in the UK, these happen more and more frequently. We effectively have 2 budgets every year. So you get a lot of domestic change. That makes it quite difficult to plan when you're not sure what's going to happen. When you've got a limitation on the maximum amount that can be deducted at source on payments that are coming back to you in your jurisdiction, you can be pretty confident, if that's done by a double tax treaty, that that's going to have some permanence. So in that sense, the double tax treaty is the more significant consideration when you're looking at a cross-border event. It's likely to be around longer. But remember, it's still trumped. What's still more important is what the domestic law is at any time. The treaty can also provide for certain information exchanges. It can provide for certain points of interaction between businesses and the tax authorities of the jurisdictions who are signatories to the double tax treaty. And in that way, it can help with tackling evasion and offshore cross-border avoidance. Yeah. I'm going to talk to you about how countries actually sign up to double tax treaties, because this is relatively interesting. The first job I ever had, or the first proper job I ever had, after I finished my degree, I worked for the UK Treasury, and I worked in a team that helped advised government ministers on tax policy. I was very junior, obviously, but I worked in this team, and my boss had the job of going around and negotiating double tax treaties. And I remember thinking that sounded just about the coolest job in the world. He would get on a plane and go to different countries and negotiate double tax treaties. I was a bit disappointed to find out that actually there wasn't really that much involved in it. You got to fly to fairly exotic places and had some good stories to tell about the nights out he had in Barbados and stuff. But actually the negotiation process was a little prosaic because it looks like this. It starts off, it's a bit like doing internet dating. Not that I'd know about that, but it's a bit like doing internet dating. Everyone's kind of toying with, sort of having a little bit of initial contact and trying to get a conversation going. I'll show you yours if you show me mine, and all that kind of thing. Oh, sorry, wrong way around. Are we going to meet up? Are we going to talk about this? We might want a double tax treaty. Do you? Well, I don't know. And then eventually they do get together and decide that they do want to have a discussion about a tax treaty. And what happens is Normally there's 2 meetings. There's one in either jurisdiction. People don't trust each other, do they? So you have one in the US and one in the UK if it's UK-US, so that you've got like a home and away leg to the match. And at that, what you normally do is present what you see as the model treaty that you're going to use as the basis of it. So the UK will turn up to Grenada and say, right, this is what we want as our basic set of rules. What have you got? And then Grenada go, this is what we want as our basic set of rules. And then normally at both meetings, each jurisdiction do a presentation about their own tax system. And they all sit there politely, like you're doing at the moment, listening to me talk about tax treaties. And they take notes and ask questions. And then they reverse that process and eventually come to some understanding. Then they get on to the nitty-gritty about the negotiation. And actually, that normally doesn't turn on that much. We want the right, we want to have a withholding tax on any royalties that are paid back to your country. Well, I don't know about that. You can have it, but no more than 10%. Oh, we say 5%, call it 7%. And that's how that works. You then go into the process of actually getting the thing put into effect. And that isn't that easy, because parties sign up to it, and you normally have a big, it's normally an ambassador that will sign up to that. So an ambassador or somebody from the Treasury or whatever the finance department is of a particular country will put their name at the bottom of that. It then goes to the process of ratification, and that depends upon local rules. So in the UK, a double tax treaty will officially be ratified by Parliament. And it goes through a parliamentary process. Nobody in this country will ever be aware, nobody in the UK, so not this country, nobody in the UK will ever be aware that double tax treaties go through the parliamentary process because it's just too technical and boring for anybody to pay any attention to, but they do. And then there's conclusion and entry into force, and they can be slightly different. You can go through the entire process, and the thing is there, it is going to be law. But normally, a double tax treaty will then state that it's effective from a particular date. And that's really to give the businesses of both countries the chance to plan what they're doing by reference to when the effect of that is going to hit. So there may only be a limitation on the withholding tax on payments under royalties from a particular date. Yeah, does that make sense? So all of those are important. So when you're looking at a double tax treaty, normally you'll find on it a date of entry into effect, and that's the key date. And that might be different from the ratification date. It might be different from the conclusion date. Okay, the date of entry into force or entry into effect is when it actually applies. Yeah. Okay. And these are the model, you get a copy of these and read them if you've got nothing better to do. And you'll find that pretty much every treaty you look at it looks pretty similar. This is the one I'm most familiar with, came into force in 1963. And the latest version, which is the one that includes all the BEPS changes, so all those extra things that are in there. So remember some of the things we were talking about yesterday, about the definition of PE? Things like that, they're all included in the 2017 version. Subtle changes in the standard wording. But basically, those subtle changes in the standard wording do have some effect, and they will be adopted by any countries entering into new double tax agreements, almost certainly. Not least because everyone's too blinking lazy to come up with their own wording anyway. So you've got the power of lethargy, and frankly, everyone's agreed that these are effective for achieving the ends of the BEPS initiative. So these articles have all been slightly amended. We looked at 7 yesterday. 2 is a definition clause. 14 we'll come on to later. Oh, sorry, I've lost some of the wording. The United Nations one is a little more recent. It's very similar to the OECD. I'll tell you a little bit, some subtle ways in which it differs from the OECD one. And the US one, again, the US one adopts some of the BEPS changes that are required and does reflect some of the changes that are recommended under the 15-point BEPS action plan in the latest version of that, which was 2016. Okay, just a tiny bit about how they differ. You can think of the OECD model as really having in mind developed countries, if I'm honest. It's a bit of an overstatement. But the way I put it there is that it favours capital exporting countries over over countries that import capital. And what I mean by that is we've got this country over here, and we've got this country over here, and this country's got lots of money that it wants to invest in there. Well, if it exports the capital there and invests it here in whatever way, you're going to expect to get income coming back to this country. The basic thrust of the OECD model is it wants to limit this country's ability to deduct tax on that income coming back. Yeah? That's basically how most of the provisions work. That's the thrust of it, which is absolutely fine. This country's not going to complain about that, is it? Provided that this country also has invested lots of money there and it's got income coming back that way. So as long as they're pretty much equal in terms of how they go about their capital investment into each other, if there's lots of businesses here setting up there and lots of businesses here setting up there, that's fine. Restricting the amount that this country can deduct on payments coming this way and this country can deduct on payments coming that way, absolutely fine. But that's a bit different, isn't it, if the country here, I'll do a different colour, that's a bit different, isn't it, when the country here actually is in desperate need of capital, and there really aren't any businesses that want to invest over here. So the country here is really keen to encourage lots of dollars to be put in here, and it's going to be paying back the revenue from all that investment over there. If it's not got a lot of investment going on over here, it's not so keen on that, is it? And the UN model treaty kind of works the other way around. It's a little bit more equal, so it's probably regarded as being the kind of thing that a developing country would want to enter into with a more developed country, and the more developed country would want to enter into the OECD model treaty. That's the basic difference. Really, the OECD one eliminates or mitigates the double tax effect by requiring the source country, that's the source country of that income, the source country to give up some of its taxing rights. Yeah? Like I say, the UN model treaty works the other way around. It imposes fewer restrictions on the taxing rights of the source country, and it imposes some restrictions on the taxing rights of the recipient country. Just a couple of examples of some of the differences. They're pretty technical, to be honest. I mean, these are, double tax treaties, like I say, are very similar in nature, and it's pretty boring when you go through them because, all the provisions look really, really similar. But, I mean, Article 12, royalties, the UN model doesn't prevent the source country from imposing a tax on royalties paid by the resident of that source country to a resident of another state. The OECD one does, or it limits it. Taxing rights over the business profits of non-residents. The UN model gives greater rights to tax the business income of non-residents. That's what I'm saying here. I'm saying that in the UN model right, the non-resident here, there's more rights for this country to tax them than in the OECD model. And there are little differences. Can anyone remember the context of this? Oh, I've given it away. It's permanent establishment definition. When can a building site constitute a permanent establishment? Well, in the UN, as soon as you've got 6 months there, you've got a permanent establishment. So you've got a building site in that country for 6 months. That's a PE. What does that mean if it's a PE in that country? So, just a little louder, please. It's taxed there, yeah? Exactly. Okay, whereas in the OECD one, it's 12 months there. So you can see the natural implication of that. It's easier to be taxed under the UN model there than it is there, yeah? Because you've got the creation of a taxable entity in the form of a PE quicker there than you have in the other country. Make sense? Yeah? So that's the basic difference between the OECD, and that's the only thing I can really think of telling you. It's the basic difference between the OECD and the UN model treaty. OECD you can think of as favouring this. The OECD is kind of in favour of the big guy, yeah? The guy with all the money who wants to invest. You want to help him invest, encourage him to invest. The UN's in favour of the underdog. That poor guy hasn't got any money over here. They don't want him robbed of his taxing rights. You can think of it that way, okay? And that's an exaggeration, but that's basically what it is. The US Model Treaty I won't say too much about. You can access all these obviously online, so you can read any of these treaties and work out what they're about and how they work. It's relatively recent, the most recent update to this is spring 2016. And yeah, whenever the US Treasury Department goes into negotiations on double tax treaty, like I say, they have that, you know, that internet dating thing where that's, you know, we're going to talk, we're going to meet up, and then they finally get together. The thing they drop on the table always is the US Model Treaty. They won't drop the UN Model Treaty or the OECD Model Treaty on the table. The US Treasury official will drop, or the ambassador will always use the US Model Treaty. And this is the most fatuous statement I'll make today, hopefully, apart from shouting at the England game. This is the most obvious statement in the world. Guess what? It aims to eliminate double taxation without creating opportunities for avoidance and evasion. Well, who doesn't? But that's the stated purpose of the US Model Treaty. That's obviously the stated purpose of all model treaties and any treaties that are signed up. In the latest version of the US Model Treaty, there are a few different concepts that have been introduced into this. I'll just say a little bit about these. We talked about all the BEPS action plans and some of the things that are required under BEPS. And some of these, we didn't go into detail about all of these, but in the double tax environment, what the BEPS actions are recommending is that you please keep signing up to double tax treaties, fantastic. But when you sign up to a double tax treaty, make sure it can't be used and abused by those nasty tax avoidance type people and those horrible advisors who tell people how to reduce tax liabilities. So make sure there's stuff in it, there's terminology contained within the double tax treaty to limit the scope for any kind of abuse. And there are various things that the BEPS recommendations are saying. So, for example, the inclusion of a general anti-abuse rule is one thing that's recommended. Or in the context of the US treaty, a limitation of benefits clause. Broad thrust of that is, yeah, you get these restrictions on the amount that one country can deduct by way of withholding tax. No problem with that, you can have that. And that's enshrined in the treaty and in normal circumstances will be given, but not where your motive is one of tax avoidance. And if actually you've set something up without any real substance and without any real business intent, and all you've done is set something up to take advantage of the provisions of the treaty, then the extent to which you can benefit under the treaty is then limited. And that's one of the things that the US treaty does include. And similar to that, the US treaty has introduced the concept of a special preferential tax regime. And this could be a little bit confusing because you might think when you see that, you might think, well, they're referring to a country. They're going to identify a particular country. That country is a special preferential tax regime. Yeah, that's what you might think. It isn't actually quite that. What they're talking about there is the treaty identifies any block of rules in any country that represents a special preferred tax regime. So if there's a special set of rules, and can be in any country that in other respects is a heavy taxing country, it could be a special set of rules, where there's a special set of rules that mean that certain income or certain events are taxed in a kind of low tax way, then they can identify that and they can limit the extent to which you get the treaty protection. And very broadly, that applies unless something's got a 15% prevailing rate on it or 60% of the rate that would apply in the US. That's the broad thrust of that. And where they identify any, where they've got a double tax treaty with any other country, where that country has any block of rules that constitute a special preferential tax regime, there can be a limitation on the restrictions, there can be a limitation on the benefits that you're getting under the double tax treaty. Yeah, makes sense? And yeah, that's what it's as it says on the slide. This is to stop people using the tax treaty in a way that means they get some special tax benefits that go above and beyond the objective of preventing there being a double tax charge or preventing there being a reasonable economic decision about the movement of capital, the movement of labour, and the movement of investment cross-border. That's the objective of the double tax treaty. If you're trying to do something that actually exploits the rules to get some special fiscal benefit for just your own good, then that involves a special tax regime, a special preferential tax regime, then you can be denied the benefits that otherwise would be available to you under the treaty. And there are special provisions under the US one about corporate inversions. And basically, if you've got withholding taxes and the double tax treaty says, right, we're going to restrict those withholding taxes to a certain amount on US source payments made to foreign persons, where you've had a corporate inversion, those restrictions won't apply and you won't get the benefit of the restriction of the withholding tax to a special rate. Does everyone know what a corporate inversion is? Any hands? Wave those hands in the air like you just don't care. Nope, not a hand. Okay, shall I tell you what a corporate inversion is?
Yeah, I could try.
Oh, fantastic, go for it.
If a company has invested money abroad,
Yeah.
from US perspective, and it will return their investment value back to US, that's the inversion.
You're on the right lines. We might be talking about the same thing. I'd just describe it slightly differently. Yeah, the answer there was that if the US company has invested money abroad and returns the money to the US, it's. I'll just see if this is what you had in mind with that. But a little while ago, the US started seeing a rash of this same event, and it sort of looked like this. You got a big company in the US, so there you go. There's my drawing of a manufacturing company. That's the best I can do, as I say. There's a big manufacturing company in the US, and guess what? All of a sudden, this foreign company wanted to take it over, and so this foreign company here, in a tax jurisdiction where the corporate tax rate was lower, are there many jurisdictions where the corporate tax rate is lower than the headline rate in the US? It's coming down in the US, but until recently, everywhere had a lower corporate tax rate than the US. The US had an incredibly high corporate tax rate. And guess what? This company here suddenly decided it wanted to buy this company here, and it acquired that on a share-for-share exchange. So all of the shareholders in this company became shareholders in that company. Who was this mystery buyer that came along out of the blue to buy the US company? Well, guess what? It was these guys. They just effectively create their own buyer overseas, and that buyer comes along and buys the US company. You can do that without any immediate tax consequences. What have you done in doing that? You've created a taxable entity outside the US. And actually, believe it or not, you can get outside the US corporate tax rate by doing that. A really simple thing. It's effectively, they've changed the rules on this now. So, I mean, it seemed too easy to be true. But they've changed the rules on this now to mean that it's actually harder to get within those rules anyway. But you still can if there's a genuine change of economic ownership to a certain extent. These were being done rather blatantly, where there wasn't really any change of economic ownership at all. The people that owned this were the people that owned that. But then through intercompany charging, they get all the profit up into this company. And believe it or not, that was effective until only a few years ago. Some rules, so it's similar to what you're saying. I mean, it's...
If we an example of money, but it could be assets or manufacturing, any subject to tax that would create corporate tax.
Yeah.
Was,
Yeah, no, you're right. You're right, because this still involves the movement of assets from there to there. The assets are normally intellectual, so it's normally something that gives this company the right to charge that.
Yeah.
Sorry.
Anything that could be subject to corporate tax was moved abroad.
That's it. No, that is right. Yeah, that's exactly right. It's effectively what's producing the profit here ends up in the company there. Now, that is easier in lots of companies than you might think, because the thing producing the profit here often will be the intellectual property. Once you strip out the intellectual property from that company and you put it up in this company, actually that company's got all the profit. And so that's called a corporate inversion. So it's effectively manufacturing, creating a takeover by your own overseas entity that puts the tax base of the US company outside the US. Astonishing that could work, but it did, apparently. Like I say, they changed the rules on that to mean that that would only work anyway under domestic law if the ownership of that company is very significantly different from the ownership of that company. If you've got ultimately the same owners of that and that, then that wouldn't achieve anything anyway. It would still now stay within the US tax code. But in situations where it still works, there won't be any limitation on the withholding tax of dividends paid from that company to that company. See how that works, yeah? So that's an important one in the US context. There's something called the derivative benefits test that's built into that. This is actually a let out from the limitation of benefits clause I'm talking about. And it's similar to, it's to do with the economic ownership not changing. That's quite technical, I won't go into that at the moment. There is a change in the definition of permanent establishment. This is very similar to the things that we talked about yesterday, where the change in wording is intended to ensure that people aren't abusing the definition of permanent establishment. It's much harder to create something that isn't a permanent establishment by using a commissionaire arrangement, for example. This is a little different, I think, to the OECD one. If there is a change, you see, you can actually, like I say, when you're looking at cross-border transactions, what was the first thing I said you'd look at if you're looking at two countries and you're doing something between them? Is it the tax treaty, the first thing you look at? It was something else. What was it? Domestic tax law, local, thank you very much, madam. Local tax law is what you look at. It's possible to actually undo the work of those, my old boss who used to go to exotic places to negotiate double tax treaties. It's possible to undo the work of those people by making a change to domestic law, which actually the effect of that can be that it negates whatever the double tax treaty says. The US convention, model convention, includes a requirement that if you're going to do that, if you do change the law to mean that you can't, something's going to affect the operation of the double tax treaty, you've got to speak to each other, yeah? So that's an important requirement. This is a summary of the articles in the US double tax treaty. This is to do with all the things that apply to income, so all the things that we'd be looking at about dividend payments or payments of royalties or payments of interest or payments in respect to business profits or payments in respect to employment or artistes and all that kind of thing. All those provisions are in that part 3. The other things look similar to the provisions that we have in the OECD model treaty anyway. This is also reflected in the OECD model now. This is referring, do you remember yesterday we were talking about the mutual agreement procedures? There's something contained in the US model treaty as well to tell countries who are participants, who are signatories to a double tax agreement, that they must speak to each other about having mutual agreement procedures and they must find ways of resolving any conflicts in interpretation. Yeah? Okay, everyone happy so far? I've not said anything particularly outlandish, have I? Double tax treaties are there to help in cross-border transactions. They don't tax anybody. Local rules, only countries, sovereign states tax people. So sovereign states tax people. The double tax treaties limit the extent to which they can tax certain transactions to make sure there isn't any double taxation and to help cross-border transactions, to help exchange of information, to limit tax avoidance and tax evasion. That's all we've said so far. And 3 model treaties that pretty much all international tax treaties are based on. Okay, so you're going to get a chance later on to have a look at some tax treaties when you're going through the exercise, but how do you interpret tax treaties? Well, that's easy. You read the blinking things and you work out what the words mean. So that's all you have to do, isn't it? It's like interpreting anything. Nothing special about that. But there's something a little different when you're looking at tax treaties. and there are some big challenges when you're looking at tax treaties. And generally, when I'm talking about how you'd interpret a tax treaty in a UK context, I'm normally warning my colleagues and my staff and other people I work with that you have to be careful not to take too literal an interpretation of a double tax treaty. If I talk about a purposive interpretation, does everyone know what I mean? There's a big debate under UK law about whether the courts should take a literal interpretation of law or whether they should take a purposive interpretation of law, okay? So if I said, for example, so just a ridiculous example off the top of my head, if I said, for example, I do not want you've got to pay me £1,000 if you lean on a table, then you'd probably take your elbow off the table. I'm not asking you to do that, by the way, but you'd probably take your elbow off the table. But then I'd go, you don't take your elbow off the table, right, I want £1,000, please. You say, this isn't a table, it's a desk. Look at the definition of a table. A table's got to look like this. It's got to have this particular feature. A desk is different. A desk is actually specifically designed for writing on and for undertaking a work duty. This is a desk, not a table. I'm fine to lean on it. You get the point? Now, if we looked at what the purpose of that agreement was, that I would fine you for leaning on the desk. If it was that, well, I thought you weren't paying attention, so it's an indication of that. That's a purposive interpretation. It doesn't really matter that it was a table or a desk. That wasn't the point. If actually it was, by the way, I'm not suggesting you can lean all you like. If on the other hand, it was a completely different purpose for which actually whether or not it was a table or a desk really mattered, then we take a literal interpretation of it. So that's the difference between a purposive and a literal interpretation. And there's a whole debate going on about this in the UK at the moment. And generally, the courts in the UK have been incredibly kind to people like me who've come up with tax planning ideas in taking a literal interpretation. So when we say, but we didn't pay a dividend, did we? But we didn't pay a salary, did we? We made a loan that we could, that never needed to be called back. That's not a payment of benefits, is it? That's a loan that doesn't need to be called back. It's different. It's a deed of promise, or whatever it may be. So you come up with interpretations, you come up with words that don't literally match with the legislation, but come on, everyone can see that it does the same thing. And the courts have actually been quite kind in the UK to the tax avoidance industry, to be honest, in allowing literal interpretations. And that's moving slightly. And that's always a warning you have to give to anybody working in the UK, because while the courts on domestic law have been kind on giving a literal interpretation, it's probably less so in the case of a double tax treaty. And there's good reason for that. There's good reason why, when you're looking at a double tax treaty, you'd really want to be taking a broad interpretation that looks at the purpose. Why on earth was that rule agreed? Why did we agree that you would pay me £1,000 if you were leaning on the table? There's got to be a reason for it. What was it about? If we can work out what that was about and why we agreed to that in the first place, maybe we can work out whether or not you're in breach of that rule, yeah? And that's a purposive interpretation. And the reasons, there's several reasons why I think a purposive interpretation is much more likely to find favour when you're looking at a double tax treaty. I'll just flick on. The first is that treaties do have a broader audience. By definition, a bilateral treaty is speaking to the populations of two countries, not one. There are differences in how those countries operate. There may be differences in their legal systems. They may have cultural differences. They may have linguistic differences. And it's rather unfair, isn't it, to stop a treaty doing its job because it used the word desk and not table, when actually the signatories to it didn't really think about the difference. It was just a thing to lean on. That was all we're after. Why should you be looking at the absolute literal interpretation of the words? And that's really the difference. It's really because in a double tax situation, you've got those cross-border differences, and you've got to be sympathetic towards those. You can be less so under domestic law, and courts in the UK have been unsympathetic to those wanting a purposive interpretation, because they've just said, if you meant that, why didn't you say it? Which is a bit harsh on the people that like the law, to be honest. With double tax treaties, it's going to be different. And what you're doing when you're interpreting, you're doing this. You are, of course, looking at the meaning of the words. What does the word table mean? What does the table got to look like? What does the word dividend mean? What does the dividend got to look like? What does the word interest mean? What does that actually look like? You're looking at the meanings of the words, and you're looking for that purpose at the normal dictionary definitions of those words, of course. But you are also looking at the context in which they arise. What does the context mean? Well, I'll be talking about different evidence, different bits of evidence of context in a moment. And importantly, you're looking at why that rule is there. Why did the two parties agree to that? What was the purpose? And if you understand the purpose, then actually somehow accepting that isn't a dividend is just completely contrary to the purposes of both the parties, then you're not going to get that literal interpretation. And this also in part, by the way, because treaties are to do with relieving and not imposing tax, I say. And because the things that are being nice, they're being kind, it's kind of, I think the courts generally would take the view that you shouldn't really be imposing a really harsh standard in interpreting them. There's something called the Vienna Convention on the Law of Treaties. Has anyone read the Vienna Convention on the Law of Treaties? Can you raise your hand if you have? Blimey. Have you really read the Vienna Convention on the Law of Treaties? Sorry?
Not all of it.
Okay. Yeah, okay. I've never had to read it personally. All I know is that it's there. And do you want to tell us a bit about it?
It's basically there to if you can't make out whether you can't agree on the interpretation of the national treaty, use the Vienna Convention to hopefully solve differences we have.
Yeah, so the comment there was that if you can't agree on the interpretation of and importantly said, an international treaty, the Vienna Convention applies to all treaties. So tax treaties will be the last of its concerns, but they're covered by any international agreement or treaty, can be interpreted under the guidance provided by the Vienna Convention. And a treaty shall be interpreted, this is the basic rule, a treaty shall be interpreted in good faith in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in light of its object and purpose. And you can see if you take that, that's a pretty clear statement that you've got to be undertaking a purposive interpretation of what a double tax treaty is about. So if you think you've come up with a fantastic little loophole, a brilliant idea, because it uses the word income instead of disposal or something like that, then you're probably wrong. It's probably going to be that it will be interpreted in a way that pushes it back to its originally intended meaning. But there's some sort of flaws when you're relying on the Vienna Convention. I mean, it's not perfect. Article, I said I'd say a little bit more about context. Article 31.2 says what you've got to do when you look at the context of a particular provision of the treaty is to text the treaty as well as any agreements made between the parties when they were in the process of concluding the treaty. So there might be some correspondence between the parties, there might be some other things that have happened. They can all give you a clue to what the context is. Any subsequent agreements as well may be taken into account. And remember, it does say it's the ordinary meaning of words, but taking into account this element of context. But like all of these things, it's flexible, which means it's vague, and it doesn't really lay down any kind of concrete rules that you can be certain about. So you can't rely on this. You wouldn't want to, if you were a tax authority and you were, wanting to make sure that this got you the right result, you'd be on slightly uncertain ground, to say the least. So, for example, if you're looking at, well, the normal dictionary meaning of the word says this, but the context says that, so you come into different conclusions. Which do you rely on? How much weight do you put on one compared to another? It's not a completely satisfactory means, and there'll always be some question about how you're interpreting the terms of a double tax treaty. I'm not an expert on international law, and how do you enforce international law, and what weight do treaties carry. Ultimately, I think the best way we can think about this kind of stuff is that if you enter into double tax treaties, it's a bit like being in a club, isn't it? if you agree to abide by the rules. If you don't, then nobody's going to want to deal with you, nobody's going to want to talk to you, everyone's going to bitch about you and ignore you. And you don't want to be excluded from international processes by not respecting the terms of international treaties, ultimately. That's probably the biggest sanction that can be placed on people. Well, it's not the biggest sanction. You can have financial sanctions and other things that people can place on parties to treaties in the event that one side fails to fulfill their obligations. But, you know, it's not easy, is it? People don't want to go invading each other because they haven't respected their double tax treaty. So how far do you go? What do you do? And ultimately, it always will be difficult to know how binding a treaty is. But in the normal course of events, a treaty will be respected by all parties, and I can't think of many examples where they haven't been. There's a couple of things that, that you can do with knowing when you come to interpretation. The principle of common interpretation means that you've both got to agree at the start that a particular thing that you're talking about does mean the same thing in both jurisdictions. So you're overcoming at the start when you're negotiating the treaty those kind of linguistic and cultural differences. And where there's more than one official language, all versions are equally binding. You've got some oddities. For example, in China, they say that if the English version of the Chinese double tax treaty with any country, that takes precedence over the others. If everybody thinks that they're not sure about what the others mean or they say something different. Okay, in the next 20-odd minutes, then we'll have a coffee break. In the next 20-odd minutes, what I want to talk about is what the significance of double tax treaties is. I've already touched on this. And I want to make sure we understand that double tax treaties are only a bit of the picture and that there are other things that we need to talk about. And I'll be talking about some anti-avoidance rules and other things that are relevant when you're looking at any kind of cross-border planning. And you've got to think about, when you're looking at any cross-border planning, the treaty is important, but I'd almost go down this process. If you're looking at cross-border planning, first of all, you think, is there a commercial reason for doing what you're doing? That's got to be a big driver because there's going to be a whole lot of cost. If you're setting up a company in a particular jurisdiction, why are you doing it? And is it really just to access low tax rates? Because if that's the case, then you're probably on dangerous ground. If there's other reasons why it's good, then it might work just fine. Okay. The next thing you're then looking at is what does the domestic tax law of that jurisdiction say? How are things taxed in that country compared to the country that we're dealing with to start off with? Then you've got to think about what it is you're creating. If you're creating a company in that jurisdiction, is that taxed? If you're creating a partnership, is that invisible? Is the owner of that taxed? If you're creating a company and then you pay dividends back to your home country, who's taxed in the home country? You've got to think about all those things. And then you're getting on to how the double tax treaty might help. The double tax treaty might help by limiting the extent to which you can have tax taken as a bite in the first instance from any payments coming back. Yeah? So that's the kind of context that you need to think about a double tax treaty. It's domestic rules, it's commercial. Think about the commercial reasons why you're doing what you're doing. Think about the domestic tax laws. Think about who it is that's being taxed and what entities you're using. And then you can be getting on to looking at whether or not the double tax treaties help you because of some restrictions they provide. And if you're looking at any cross-border planning, there can be, we all know the reasons why we will enter into special cross-border and international arrangements. You can create, if you can create something that's an effective group structure and actually has some commercial rationale and some commercial benefits, that's clearly a major driver. If you can, in doing that, operate in a more tax-efficient way by accessing lower headline rates or accessing better tax incentives or accessing better timing for payment of tax, then all of that would be great. And if you can access something that means that when you exit from the entity that you're creating, you've got some tax benefits, that would be great as well. So all those are reasonable objectives. But like I said, the treaty only comes in, you've got to contextualize it, the treaty only comes in as part of the picture. And, you know, and you'll see this in the exercise we're looking at later on, any event that you're looking at, you've got to be thinking of it in a slightly different way. So I mean, think about this. You've got company A in state A and you've got company B in state B. And basically what we can do is we can arrange for company A to buy stock or services from company B. And what that means is that when it buys the stock or services, we get a reduction. Deduction for tax purposes in company A, and we get a taxable amount in company B. Well, that's great. You may go straight for the double tax treaty between state A and state B, but you'd be doing the wrong thing, wouldn't you? Because the first thing you've got to look at is, well, that's absolutely fine. We've created the profit here, and we've created no profit there. Great. But hang on, what are the tax rates in these two countries? Because if that's a high tax rate and that's a low tax rate, that makes sense. If it's the other way around, that doesn't make sense. What are the relieving provisions, the special provisions that might apply in any of those countries? Is there something that means actually we don't mind having taxable profit there because we can reduce that by other means, for example, generous R&D expenditure relief. So actually, is that the place that we want to have the taxable profit? And actually, if we do that anyway, are there anti-avoidance rules that stop us doing that? So do the transfer pricing rules between those two countries mean that we can't really sell stock or services at that particular price? We'd have to sell them at a different price. That means that the profit isn't recognised in the state where we want it to be. Subject to all those points, you might still conclude that this is a great idea and it's great to have the profit there rather than there. Then you want to look at what the double tax treaty says, because is there a limitation on who's got the taxing rights, which country's got the taxing rights for the profit that arises there, and which country, can either country impose a withholding tax on any of the payments that are made for the trade between those two companies, and if they can impose withholding taxes, are they restricted? So that's the context of the double tax treaty. And similarly on this, you've got state A and state B. So the company in state A is the holding company of the company in state B. Can it lend to company B? And can company B get a tax deduction on the interest that's being paid back? Can it invest by way of capital in company B? And then can it take dividends back to company A? If you went straight for the double tax treaty, great. That would tell you about what the restriction on the withholding tax on dividends is. It would tell you about what the restriction on the withholding tax on interest is. But that isn't the point, is it? The point is, are dividends taxable in this country under its domestic law? Is there a restriction on the interest that's relievable in this country under domestic law? So they're the things that you're looking at first. When you've looked at those and you decide that actually that company investing by way of capital in there is best and a dividend is paid, yes, then you are looking at the restrictions under the double tax treaty on what the withholding tax on the dividend can be. That's the way around you're doing it, yeah? And another part in this is, again, when you're looking at something that's any form of international structuring, you've got to think about who it is that you're going to end up giving the tax liability to, because you've got different choices about the structures that you can use. Some things are, the double tax treaties all talk about who the entity is that's being taxed, and they identify different entities that are going to be taxable they identify the entities that we need to take into account in working how the provisions of the double tax treaty apply. Some will be transparent for tax purposes and they won't exist at all. So you won't have an entity that's being taxed in a particular jurisdiction. It will be the owner of that is taxed, and the double tax treaty won't come into it at all. Or, to be accurate, the double tax treaty will come into it in a different way to the way you might be intending. So, for example, if you have a transparent entity in that country and a company in that country, if you were thinking you were going to be taxed on a dividend coming from that entity to that entity, because under your domestic law you are, you might not be if that country sees this as transparent, because you might just be taxed on a payment for business services. So the identity of the entity, the nature of the entity will determine who it is that's taxed, and that will tie in as well to the type of income that's being taxed and the particular provision of the double tax treaty you're looking at. So like I say, the choice of entity is important because that will determine to some extent what you are accessing, what you're looking at under the double tax treaty. Is it to do with withholding tax on dividends? Is it to do with withholding tax on services? Is it to do with withholding tax on royalties? All these things are going to be important, and so being clear about what the entity is that you're using is equally important. I'm going to say a bit now about the different types of income because, again, different types of income are treated differently under double tax treaties, and double tax treaties normally have different sections that deal with different types of income. And there are a couple of things that are important for income. One is where it's coming from. This may seem blindingly obvious, but it's not in all circumstances. So where's the income coming from? What's its source? And what is its nature? They're the two things you've got to be asking yourself about when you're looking at any kind of dividend income. And the main dividend income that you're looking at under double tax treaties, well, the ones where you're going to get withholding taxes under domestic law and where the double tax treaty will relieve those withholding taxes are dividends, interest, and royalties. And this may seem blindingly obvious because you might think, well, obviously, if that company there is paying that one a dividend, then that's the source and the dividend is going there, and that's usually the case. But it can get more complicated because what if we have a holding company there and a subsidiary there, but that company is liquidated? Is that a dividend? Actually, under UK law, that depends. It depends on the manner in which it's liquidated. So there are different ways in which you can liquidate a company. So a payment of profits, something representing profits from that company to that company, usually will be in the form of dividend if it's a distribution of the profits. But what's a distribution for these purposes can depend on domestic law and can vary depending on the exact circumstances. So you've got to think about that. You think, again, interest is obvious. Everyone knows what interest is, except it's more complicated than that nowadays because you can have some quite complicated financial instruments that mean that what looks like interest to you or me actually isn't interest when you look at it in the context of a double tax treaty. The standard double tax treaty definition is income from a debt chain. That chain can be quite short. It can just be two links. But where you have a debt relationship or a series of debt relationships that form a chain, the income from that is interest. But actually it's not obvious and it's not easy to always identify that you do have interest. Believe it or not, it looks simple. Royalties is actually significantly harder because there aren't really any detailed rules about what the source of royalties is for the OECD treaty, or indeed what the identity of royalties is. That again, you might think, well, hang on, we all know what royalties are. Somebody's using some IP and they're paying for the use of the IP. But sometimes you can have a different person paying for that. You can have party A using the IP, party B actually paying on behalf of party A for the use of that IP, quite common. And actually, is that a royalty payment? If you sell royalties, is what you receive a royalty income payment? These things aren't always clear, and it does depend upon the local rules of taxation of those events and also the local law as it applies to royalties. And also, what are royalties? Generally something like a patent, something with a legal standing, the way you can legally protect it under domestic law. That's a piece of intellectual property, and the income coming from that is normally regarded as a royalty, but there are some disputes about what falls within that definition and what doesn't. So again, it's not actually obvious. And an important thing as well that you'll want to look at, and so it's another consideration really, is where somebody is resident and which country has the primary taxing rights. And here, it's another good example of where you're actually looking at domestic law first, and then you're looking at the double tax treaty. Because who's got the primary taxing rights will always be determined under domestic law first. The only problem is that when you look at the rules about domestic law, frequently, happens all the time with individuals, frequently you come to the view that yes, somebody is resident in the UK, but yes, they're also resident in Belarus. So they're resident in both countries. So what do? And lots of double tax treaties will contain a tiebreaker clause to mean that in those circumstances you look at some defining element which is clearly going to work one way or the other. And we used to use the tiebreaker clause thing in double tax treaties was a big one. There was a big thing about 20 years ago in the UK. We used to do a bit of planning. Is anyone here from Belgium? I didn't know you were from Belgium. Yeah. Sorry about last night. That's the last football reference I'll make for the next 5 minutes. I thought you were looking a bit sad, actually. Yeah. So, really? Yeah? Oh, dear. If you feel the need to pop out for 10 minutes, I will forgive you, don't worry. I've got some worse news for you about how we used to abuse your country's tax system. But there used to be some planning that was common in the UK for capital gains tax purposes, and this involved sending individuals to live in Belgium. I don't know if you're familiar with this. This basically worked on the premise that Belgium didn't tax gains on securities. So if you sold shares in a company or you redeemed loan notes in a company, there was no capital gains tax in Belgium. In the UK at the time, there was a 40% rate of capital gains tax. So what we did was we deliberately made people both UK resident. They weren't going to stop being UK resident. They didn't want to leave the UK particularly, but we'd also make them Belgian resident, because by default you could become Belgian resident just by registering with a commune. So you would register with a particular area, and that was a pretty easy process. And strictly within these walls, we used to, when I was at PwC at the time, we used to advise people to go for 6 months, to live in Brussels 6 months. And that was the idea. I know of several clients that were there for a week. And they registered, they had their police visit, because that's what used to happen. The police used to come around to check you actually had a house there. That was it, ticked a box. You were by default Belgian resident. You would pay some tax in Belgium, but very little. And you then weren't taxable in the UK, because there was a tiebreaker clause that said, if you were both resident in Belgium, you were, we could prove it, we got the document to say so, and you were resident in the UK, you clearly were, because you lived there in your home, and domestic ties were all there. If you were resident in both, then you took a particular tiebreaker, which was dead easy to satisfy in favour of Belgium. And unless the Belgian authorities decided that they were going to challenge that, and why would they, unless they decided they were going to rebut that, then you were Belgian resident. So that's the kind of way in which, I'm afraid, let's be honest, that's treaty abuse. Your days are just getting worse and worse. But that's what the purpose of a tiebreaker clause in a treaty is for. And so understanding that and understanding where the liability lies is important. I'll just say a little bit about dividends. I'll probably just rattle through these because I want to get you away a little early if I can. Yeah, dividends, you'd imagine when you're looking at different types of income that might be relevant for a double tax treaty, you'd imagine this is very, very easy. And everybody knows what a dividend is. A dividend's a payment that you receive on the shares in respect to the profits of that company. You just need to be careful whether it does extend to some other things. For example, where a company repurchases its own shares, if you're familiar with that as a legal concept. So a company buys in some of its own shares from shareholders. Is that a dividend? Well, in some countries it is, in some countries it isn't. In the UK, for tax purposes, it may or may not be, depending on the circumstances. How's that treated under the double tax treaty? Under the model treaty, generally you have quite a significant limitation on the withholding tax that could be charged on dividends when you get a dividend that's paid from that country to that country, if it is a dividend. But when you get a dividend, there are normally quite generous restrictions on what the withholding tax is. There's no withholding tax when you get a payment from the UK generally. And the normal OECD model is that there should be a lower threshold for withholding tax where you've got a larger participation in the country. It's normally talked about in the company, normally talked about as being a participation exemption, and that can vary from country to country. It might be that where you own more than 10% of the shares, where this company owns more than 10% shares in that, there should be a participation exemption. And there should be a restriction, a generous restriction then on the withholding tax. So generally, under the model treaties, dividends, the encouragement is for dividends to be treated quite generously and there to be little withholding tax by jurisdictions. And you can see the logic in that, can't you? I mean, that's to encourage residents of this country to invest in entities of that particular nation, knowing that when the dividends come back, they're likely to have little or no tax deduction on them. That's the encouragement under the double tax treaties. You just need to be careful about what a dividend is and what that actually applies to. Again, interest, you'd imagine that this is really, really simple, and you'd imagine that everyone knows what interest is, and to an extent that is true. And there is a definition, which is that it's the income that you get from a debt chain, but you just have to worry about certain special instruments. I don't know if there's anyone here in the room who's an expert on things like swaps or exchange for or futures exchanges or things like that. I'm certainly not, but I've come across these in practice. But the point is, the more and more sophisticated financial instruments, and as things become more and more sophisticated in financial markets, you get instruments that confuse what is an interest payment compared to what is return of capital, compared to what is an equity share or a profit share. So it isn't always obvious what you've got, what you're getting in terms of interest. Royalties is, the definition of royalties is strangely enough, royalties is the thing that's been in the news most, isn't it? Because some of the big tax planning that we've seen with multinational companies involve Google here sticking all their rights, all their intellectual property rights in Panama over there, and basically all of the income that Google earns really isn't taxable there because they have to make such a massive royalty payment over to Panama in order to use the name in the first place. That kind of planning is the thing that really hit the headlines in recent years. So intellectual property planning, or intellectual royalties and intellectual property is a huge matter in international tax. Oddly, given that the definitions are actually quite weak. So there are some definitions that talk about a royalty being relating to something that's a protectable legal intellectual right, something like a patent that you can register, and you can register in a particular jurisdiction. It can be protected from legal challenge, but there is some ambiguity about it, and there are other things where there are ambiguities. For example, a payment for the use of a particular bit of intellectual property, yes, that looks like a royalty. But if you buy the intellectual property, or you buy a particular set of rights over the intellectual property, so again, you make the particular legal agreement more complex. Where do those payments fit in the context of royalties? And that isn't altogether clear. Yeah, I'll just say a little bit about capital gains then before we run on to we'll finally talk about the multilateral instrument. Taxation of capital gains and the cross-border taxation of capital gains, you would think would be quite easy, wouldn't you? Because if you're selling an asset, disposing of an asset, then all you've got to do is look at where that asset's located and tax it there, yeah? So that looks absolutely fine. And that's what most jurisdictions do. So if you've got property in a particular country and you sell it, then the primary taxing rights lay with that country and not with the country where the person who owns the property may be. Strangely, in the UK, that wasn't the case until very, very recently. If you were a non-UK resident individual and you owned, flats in London, like lots of my Russian clients, then if you did that, then you sold them, then you were completely outside UK capital gains tax because it's purely governed by the residence of the individual. One problem with following the geographical location of an asset is that you can change the geographical location of an asset, can't you? How do you do that? I don't mean by hiring bulldozers and stuff, but if you've got this, say, country and you've got a house in that country, there you go. Well, what you can do is you can create in your own country, you can create a company, can't you? And you can transfer the legal ownership of that house into that company. That has changed the legal situs of this asset because you now own shares in that company rather than owning that house. So what you then sell is you sell the shares in this company. Increasingly, domestic legislation, the UK domestic legislation has cottoned onto that. So that's understood. So now if you were to do that in the UK, you'd find you still have a gain, even when you sell this company. Our Russian friend there would still have a gain when he sells that company, just as he would have done if he sold those properties. But that isn't always the case. So that's just one thing you need to be aware of when you're looking at capital gains tax, is what does it apply to? Does it follow the geographical location of an asset, which most jurisdictions do? And then does it have any more sophisticated rules to stop the change of the geographical location of the asset by the imposition, by putting in place a company or something else that owns the asset? Just remember that when we're looking at cross-border planning, the order of events, as I said, domestic law, you've got to look at the reason why you're doing it. What's the commercial reason for what you're doing? Is there a commercial reason for what you're doing? And when we look at the session after lunch about substance, you'll see why this becomes more important. Then you're looking at what the domestic tax rules say. Then you're looking at what entity you're using and what's the right entity and what's the right ownership structure for that particular entity, and you're working out the income flows. Then you might be looking at the double tax treaty. But probably even before that, you're looking at all these things. You're looking at any special anti-avoidance rules that mean that, notwithstanding the fact that the headline rate means that there isn't a tax charge in that jurisdiction or that jurisdiction, that's trumped, that's changed by some special anti-avoidance rules. And I could have put on that list as well the general anti-abuse rule. So can a country just bring it back within their tax regime anyway if the thing doesn't have commercial reality? Very, very difficult to know how to fit that in, by the way. And these are conversations that we need to keep quite open. I'll just very briefly say something about the multilateral instrument. I mentioned this yesterday. This came in 2016. And the multilateral convention or multilateral instrument it's really intended to, what this is doing is saying to all the OECD members and all the other signatories to it, it's saying, look, we want your double tax treaties to have these extra provisions in, right? We want them to have, for example, a limitation of benefits clause. We want them to have a general anti-abuse rule. We want them to have some other provisions that mean, for example, your transfer pricing rules work more effectively. We want them to have provisions that mean that your definition of permanent establishments isn't weak. Blimey, say all the members, how much work is that going to involve? Got some great news for you, say the OECD. It's not going to involve any work at all. Here they all are. Sign up to this, and this presupposes that all your double tax treaties that you've signed with anyone ever include those provisions. What do you say? And the member states go, well, that sounds great, but oh, hang on, better have a think about this. I don't think the Isle of Man are going to be happy with that. So you can opt out in respect of that particular provision. You can opt out apart from the most basic protections that are provided under the MLI. And so 60 countries have signed up to this. So what that means is that this basically is, all I'm saying here is that you've obviated the need to go and renegotiate all those treaties again. Do you remember our internet dating thing? You know, do you want to chat? Do you want to chat? Don't know, maybe. And then you eventually get together. Forget all that. It's straight in there unless both countries are opting out of it. And actually, there's a chunk of it that you can't opt out of anyway. It also includes something that helps with dispute resolution and interpretation of the treaties. So anybody signing up to it will now have access to slightly better mechanisms for resolving any disagreements that might exist under it. And the idea is that this, what the MLI does is it works at a minimum standard for anti-avoidance in all double tax treaties. It works out some minimum things that really should be there. It says, here they are, pre-drafted, ready for you. You don't have to do anything. You just have to sign on the dotted line. And if you're unhappy about any particular aspects, you can opt out, which is what the flexibility is. That's it, ladies and gentlemen, about double tax treaties. You all look ready for a coffee, I've got to say. I don't know whether it's the day two blues, I think, isn't it? You know, after the excitement of the football last night and other things. But does anyone have any questions on double tax treaties at all, or anything else anybody wants to ask? Yes, go. Do we have a microphone? So would you mind speaking into our microphone so you can be recorded forever? There's got to be a law against this, hasn't there? Go ahead, yeah.
Now, I usually work with treaties that use the OECD model, so I was wondering who uses the UN model convention.
Say that once again, sorry.
Who is using the UN model convention? Because the treaties I work with is the OECD.
Yeah, I mean, that's who's used. So the question was that most of the treaties Oyana, is that right? Is working with our OECD model. So who on earth uses the UN treaty? And the answer is I very rarely see it as well. I'm trying to think of an example. It generally is used, it's favoured by developing countries, really. Of course, you've got to have a developing country that's enough of an attraction to a developed country to mean that they will follow the model UN treaty. I can't think of an example off my head of pretty much every UK double tax treaty is OECD model. Can anyone think of a UN treaty? Drawn a blank on that one, I'm afraid. Generally, though, what it will be developing countries. And the point about developing countries wanting to use it is the UN model's kind of nicer to countries that want to retain, want the investment coming in their way, but want to retain some taxing rights. So I expect where this will be used, I can't think of an example, I can find one out for you. I expect where this will be used is in countries that really have a great deal of wealth, have a great driver for wanting to invest in a particular jurisdiction, aren't that worried about there being some tax cost because the commercial benefits they can see are so huge. And the countries, so I expect China's signed up to lots of UN model treaties because in my experience, Chinese investors, you know, I've seen some ridiculous things happen with Chinese investors. For example, a case I'm working on at the moment, I'll give you this as an example, a case I'm working on at the moment, a client of mine is selling some companies that run schools. They run schools in Cambridge. In fact, rather cheekily, one of them is, in Oxford, rather cheekily, one of them carries the name Oxford College. It is not part of Oxford University. Maybe that's the mistake the Chinese have made. But they're buying these companies that own these schools. They're paying a number which makes no sense to me at all. We identified a potential tax charge for our client that he doesn't particularly want. The Chinese just said, we'll underwrite it. That makes no sense to me. Why they would agree to add 45% to the millions they're already paying. But actually they're in a position to do that because the commercial strength they see in the investment is big enough. Or they're stupid. But for whatever reason, they're willing to chuck money at this particular thing. In those situations where you've got a really heavy driver for investment in a particular jurisdiction, and the particular jurisdiction is developing and isn't going to be putting investment back the other way, and that particular jurisdiction wants to retain taxing rights, that's the kind of place where the UN model treaty would fit. Yeah?
Okay, and for the OECD,
you...
To interpret the OECD convention, there are the OECD commentaries to the convention. So it's like for interpretation only these OECD commentaries, or how do you think this is best to look to interpret them?
Okay, the question there was, sorry, the microphone's going to the recording but not to the room. I've just realised that, so it's rather silly of me to tell you to speak into the microphone a little clearer. I'm sure it's recording fine. The question was, what's the role of the commentaries that go with the double tax treaties? And it comes back to the context that I was talking about in interpretation. The commentaries are important, and if you get into a dispute about the interpretation, that will be one of the factors that's looked at. But remember, both signatories to a bilateral agreement will have access to the same commentary. So by implication, they will have agreed to what that says and where that is useful in delineating, in putting down any lines or determining how a particular thing is taxed or isn't taxed. Both parties have agreed to that. So that is, it's actually quite near the front of the queue in what you would be looking at in terms of interpreting the treaty. So I think going to the guidance and going to the commentary would probably be your first place if you're looking at any interpretation, any question over interpretation, yeah. So the commentary is very important, yeah.
Okay, and for royalties and interest, there are also the directives of the European Union. I mean, I have to look, when I have this, I have to look first at the directive, right? Or
well, the directive...
Which is implemented in the local.
The directive will be telling jurisdictions what they need to put into law and what they need to give effect to within certain parameters, and that will be reflected in the double tax treaties. So unless they're in breach of the directive, they will have agreed certain they'll be meeting with the minimum standards of the EU directive. That will be reflected first in the domestic law of the countries and will need to be reflected in any restrictions on that tax charge that they impose under a double tax treaty. So I'd say, sorry, touch wood, that's an English thing. I'd say what you don't need to look at the EU directive because it should already be reflected in domestic law or under the double tax treaty. If it's a good idea to be aware of the EU directive on savings and the EU directive, so the EU directives that affect any royalty, that affect any withholding tax payments, because some jurisdictions may be late in their implementation, or the other directives that we've seen where the implementation isn't required until next year. So if the implementation isn't yet required, then it's a good idea to have a look at that. But otherwise, if it should already be there, then actually what the domestic law says should already reflect it. Okay, great. Yes, go ahead. So the question here was, should that free kick have been awarded in the second half? Okay, sorry, that's not the question. Okay, go ahead.
So a small question, you talked about the fact that you have to look at domestic law and many other items before actually looking into the double tax treaties themselves. But just from a practical point of view, isn't it more logical, also fee quote-wise for clients, to first go and look to the double tax treaty, because a lot of items can already be determined based on the double tax treaty before going into detail of domestic law?
Okay. There'll be lots of instances where, so the question was just in terms of cost efficiency, just in terms of kind of how much work you're putting in, shouldn't you be going to the double tax treaty first? The purest answer is no, you should always be going to the domestic law first, because the double tax treaty can only ever restrict what the domestic law is. Now, it may be that you can automatically infer from that. You can look at the double tax treaty, and actually you'll probably be right most times. Most times you go and look at the double tax treaty and you'll say, yeah, we're only going to get a 5% withholding tax. That's the end of it. And the chances are that'll be right. And after all your research, that'll still be right. So in terms of, it's a bit like, when you're looking at a job and working out how you go about it, you're having a quick glance at it and going, what's that look? Yeah, that looks easy enough. I agree in that context. To actually give an answer that you can stand up to and that you know is right and that your professional indemnity insurance can rely on, you have to look at the domestic law. So the purest answer is it's got to be the domestic law. I don't disagree at all. Having a quick glance at the double tax treaty to get a flavour of where you're likely to be is a good idea, but it's in that context. Yeah? Okay. Okay, thank you for those questions.